So, oh my gosh, Sarah, I might have to have you do our intro as I keep letting people in.
Sure. What's our intro? Here we are.
Realtors.
Our monthly meetup. And you guys have probably, I think all of you know us except for you were a new face. Anne, right? Amy, thank you. That's why, yeah, names hard for me. Amy, and then Kim McGinnis. I've heard your name before, but nice to see your face. Jason's new. Anyways, we do these monthly. I'm Suzanne. I'm Sarah. That's Suzanne. Thankful in a way, right? Thank goodness. So we can both be different places at different times. But anyways, we are licensed realtors here in Oregon, and our whole goal of this is really just education and community and getting you guys to see each other's faces in person and hopefully do some deals together, learn some things from each other, and then express what it is you're here for. We're going to try and keep, well, as much as we know how important the networking piece of this is, we're going to try to keep that a little bit briefer today, and maybe just invite some of the people who we haven't met before to tell us their name, where they're hailing from, and really what their goals are for being at this meetup. And if there's anything you need from us, in this room, and what, how we can help connect you. That's who we are. We're connectors. And hopefully we can connect you with a really amazing tax strategist today. And you guys learn from it. Great.
And just quickly, just so you know, too, for those that we haven't met yet, we are both realtors. Sarah and I are both investors. I'm a private money lender, and Sarah will be very likely in 2026. And so we walk the talk. We do the things. We have worked our way, I will say nicely, worked our way through a number of different CPAs before finding Casey, and he is tried and true and amazing and has produced 5-digit results for us in 2024. And we're expecting even some bigger results in 2025. We've had our tax strategy thing with Casey already, and things are looking great. So just all that to say that, we vet everybody that we bring in to talk to you, and it's important that, we have learned from them and can bring you the wisdom, and you can hear it directly from the people that we're working with. So QR code up here gets you on our top picks email list, which we send out every single week. If you want to see all of our top picks for Ben's best real estate deals, you can get on that list. So I'll give you a second. If you're not on that list, you should check it out. We always share replays and lots of other interesting information. And for the rest of 2025, we're focusing on bonus depreciation and short-term rentals with tips provided by Casey in our weekly email to help you grasp a lot of the concepts that he'll be talking about today. So we're going to be talking about accelerating your wealth and eliminating taxes legally using real estate. And we'll just do some brief intros, I think. So like we said, a lot of you know each other. So is there anybody in the room, Sarah, that we haven't met?
Yeah, you're right that time. You got it. That was just Amy that I didn't recognize.
Must have been because you get your own name, right?
Sorry. I know where you're hailing from. How long you've been here?
Yeah, sure. So I've joined a couple virtually. This is the first that I'm joining in person. My wife and I moved to Bend about 2 years ago from Southern California. I still work 9-to-5 job in tech, but the goal is to finally invest in real estate. I don't have any properties yet, but I've been listening and learning through various methods for a very long time. So I feel ready to finally take the leap and just gonna continue learning and hopefully, ready to do so very shortly.
Thank you. I just want to make one suggestion for you, honestly. So Suzanne, you're our perfect corporate type, client, right? And so what I want you to do is go find our podcast and listen to episode, the first 1, 2, 3 episodes maybe, because it's a really great story that Suzanne tells about her transition out of that world. It's very inspiring.
I have heard it, and it is inspiring.
Yeah. Continue on online.
Okay, perfect. Jason, I don't think we've seen your name here before. So will you just tell us where you're at and you're hoping to learn today?
Hey guys, yeah, it's my first time on. So I'm actually based out of Southern California. I'm traveling right now. I'm actually in Mexico City of all places. But I spent some time in Bend, Oregon over the summer this past year doing some mountain biking. And I love the market. It's completely new to me, and I subscribe to your email newsletter and I get the announcements there. So I'm just really curious about it. And so I wanted to join this broadcast just to see what's going on and just kind of enter the waters a little bit and learn some more about everything.
Love it. Thank you for joining. I love that we have an international representation here. So I'm actually in Marseille, France. You're in Mexico.
Wow.
Yeah, we've got a lot of the time zones covered right now, which is pretty awesome.
Nice.
All right, Jill, welcome. We haven't met you before. Will you just tell us your name or your location? And we also are curious to know if you already own STRs and what you're hoping to learn. Oh, we can't hear you, Jill, but we'll come back to you, or you can put it in the chat. Put in your location and if you own any STRs and anything that we can help you with. All right. Well, anybody else just itching to share their info, or shall we dive right in? Let's do that.
Jill did respond over message if you want to read it.
Oh, perfect. Jill said, I sold my rental in May and need to save on taxes, and I'm in Bend. Awesome. Well, you are in the right place with the one, the only Casey Haynes. So Casey, we're going to just let you take it away from here and just tell me when you need me to advance your slides.
Every 5 seconds, you should be clicking.
Hey.
Hi, everybody. I'm Casey Haynes. I'm owner of Compass CPA. My firm's been around since 2017. We're a virtual CPA firm. We do service the Bend market locally. Like to put FaceTime in, build some community here. I've been a CFO for many multi-million-dollar companies, from tech to construction to real estate. And I'm also a tax strategist, which is what capacity I'm here today in. So, I have been focusing a lot in the last year on recognizing that the real estate scene in Bend is one of our biggest marketplaces, and it's largely underserved. Not many good CPAs, so I hear, and lots of opportunity. Cool. All right, so we're going to cover cost segregation today. We're going to talk about bonus depreciation versus Section 179, passive and ordinary income, the short-term rental loophole, real estate professional status, business use of a property, and then we're going to go into a couple real-life scenarios to help you guys envision how to apply these. All right, so cost segregation is not super widely known, and I'm going to teach you today. I do a lot of these workshops teaching people how to leverage real estate, how to live a tax-free lifestyle. And one of the great things about this strategy is you don't have to be a millionaire or a billionaire to do this. You hear a lot about this. Donald Trump doesn't pay taxes. This is what he does, to be clear. So I'm going to teach you on a more of a micro level on how to do this. You can leverage debt. You can leverage, small amounts of money to create huge tax deductions and live a tax-free lifestyle. So that's what we'll cover today. But, all right. So, essentially, what a cost segregation study is a study that is going to break down a real estate building into different assets that are eligible for accelerated depreciation. Typically, when you buy a building, whether it's residential or commercial, residential is typically spread over 27.5 years, and commercial is over 39 years. And so what the cost segregation study does is it isolates assets of the building into different asset classes that are reclassified into 5, 7, or 15-year depreciation lives. These depreciation lives are eligible for bonus depreciation. Anything under 20 years in asset depreciation life is eligible for bonus depreciation and 179 election. So that's like the whole point of the study.
Can you just clarify what that means really quick? So
Yep.
the property has to be younger than 20 years?
No, actually, the property could be any age. It's really about the asset classes. So like,
Inside of the property.
yeah,
Okay.
when you do your taxes and you buy a building, it usually goes on your depreciation schedule, which is one line. Like you put your address on it and you depreciate it over 27.5 years.
Right.
But the study that we do, the cost sags, they break down that one line item into many different line items. And we say, hey, there's windows, there's flooring, and those are the 5, 7, and 15-year depreciation lines. So the depreciation lines are defined by the IRS, and that's what I mean by under
That
20
helps.
years.
Thank you.
Yep. Okay. All right, let's keep going. All right, so what the study does is we identify the components. So we break down when we do a study, we break down the building into things like doors, fixtures, electrical, plumbing, and that is like the whole idea of the study is studying the building, the blueprints, the makeup of the building, and reclassifying everything and basically just itemizing the whole building into these different assets. Next. And so it's technically not even an accounting study, like service per se. It's actually engineering and architectural design. I on my team have a couple engineers that do it. There are different methods to do with a cost seg. There's statistical analysis and there's a couple others. The engineering-based analysis is what's always going to produce the best results. And it is an engineering study of, the blueprints, the makeup of the building through pictures and video documentation. All right. So what we're looking for in this study are things like the carpets, the appliances, special lighting. Next, we're going to look at things outside the building in the yard, like sidewalks, the parking lots, landscaping, and fencing. We're going to look at things like the HVAC system, plumbing, electrical systems.
So for a new building construction project where you actually have all the costs for all those things, does the engineering study actually incorporate the true cost of all that, or?
So yes and no. Sometimes when people are developing, you can almost do the study as you're purchasing because, you might hire somebody specifically for like the concrete. You might hire somebody specifically for these different components of the building. And it's really easy. That's like an actual costing method of doing a study, which is an IRS accepted method. But with the engineered studies that we do, when we break them up, we reference a database that the IRS uses called RS Means, and it has a national, international database of material costs. So it's not going to, unless you do the actual receipt method, it's going to be more of using that database.
That's what I was trying to understand.
Yep.
Thanks.
All right. Cool. So tons of benefits here. You're going to accelerate depreciation. So the big bonus, the big part of that is you get to take a big deduction in year one and help pay less taxes in that year. So it reduces your taxable income, basically defers your tax out, and you have immediate savings on your taxes. Helps improve cash flow. Typically in these situations, you're going to get a big fat refund from the IRS in the year that you do the study. We'll talk about how that can be a catapult into future investment. But like I said, you increase your cash flow, improves your ROI. The study costs you anywhere between $4,000 and $10,000 typically, and you're going to save anywhere between 50 and 100K plus, on these studies. So huge ROI. So we're getting people for what they pay us to do, 15, 20 times the amount of money they spend is coming back to them in the year they do a study. And then when that money comes back, we advise if they're interested, reinvest it, and it adds more capital capital for reinvestment. All right. Okay, so this is all what we're talking about today. Is one of the considerations is passive loss limitations. Normally, when you invest in a property, and it's an investment property, and you're not actively participating, your losses are capped. So when you just do regular depreciation, you don't satisfy STR or reps, your losses are capped, sometimes to zero if your AGI is above 100K, or you can take up to a $25,000 deduction at most. Okay. Another thing is when you do depreciation, something to consider is if you're selling the property later, depreciation is added back in tax to when you sell the property, except in certain situations like a 1031 exchange, which you can keep kicking the can down. But if you are planning to sell a property, you might want to pause, hesitate, and see if it makes sense to actually do a cost seg. Okay.
About if you sell it on a land contract or contract for me.
Sorry, say that again.
What if, how does that work if you sell the property on a land contract?
Either way, and only way that depreciation's not added back is through a 1031 exchange. So if you sell it through any kind of lending tool or contract, it will be added back. So.
Okay.
Okay. Cool. And then, of course, I try not to let people get hung up on this because you should be too short-sighted when it comes to this. But there is some upfront costs. You usually pay here this year, and it comes back to you when you file your taxes in a couple months. All right. Cool. So we're going to talk about a little bit about bonus depreciation in Section 179 next. And so accelerated depreciation, and once again, just like the real estate, if all these assets are usually depreciated over a IRS-defined span of time. But accelerated depreciation is essentially bumping that up into the first couple of years, and typically year one. So that's what accelerated depreciation is. It comes in two forms: bonus depreciation or 179 election. Okay. And so bonus depreciation is basically is an election that you take to take depreciation for the full value of the asset in year one. Next. In Section 179 is very identical to bonus depreciation. It's just another form of accelerated depreciation, but once again, 100% of depreciation in year one. There are some limits on Section 179 there. It has a $2.5 million limit for 2025. And you could go to the next one. Yep. And it also has a limit on how many assets you can actually depreciate, up to 4 million. So but they both are very similar. And sometimes when, in the last couple of years, when bonus depreciation was phasing out, the 179 election was like the catch-all that still negated kind of the effects of that phase out. So at the end of the day, what you really need to know about the two of them is they both allow for immediate expensing. And they both apply to new and used capital or properties and assets. And they're both used for tangible business property. And they can both be used in the same year together. And I think one of the big differences actually to know is bonus depreciation can create a loss state. That is where bonus depreciation is very valuable, whereas 179, you can't take more than a 25K loss from it. So that's where the bonus depreciation is more valuable. All right, next. One big beautiful bill that was put forward this summer restored bonus depreciation up to 100%. It was being phased out over the last couple of years, set to be phased out in full by the end of next year. So I'm happy with that rule. I'm not gonna lie, the one big beautiful bill, in my opinion, has helped all my business owners. I'm a business owner, maybe you guys are business owners, but other things that were going away were like the QBI deduction, the bonus depreciation. These are all things that we all really benefit from. So, say what you will, you don't want to get political here, but the bill has helped out a lot of business owners. And not just the billion-dollar corporations, but the small guys too. All
And I
right.
just wanted to point out that before that, this year it was set to go down to 40% in 2025, correct? And then it was going to phase out in 2 years. Okay.
And I was scared. I was like, cost segregations are a big part of my business. It's a big part of like a reason people invest to begin with. And I was really, so I was really happy to have it back to 100%. It's helped out a lot.
I'm sorry if I missed this. It might be a very basic question, but is there any difference between the type of property? So if this is just on rentals or short-term rentals, or can you do it on your primary residence as well?
Primary residence won't ever count because they're not eligible as investment property. It's got to be some kind of investment property or business use property.
Okay.
So
And does it have to just be property? Like, does it work for cars for the business? As well? Okay.
Yep. Bonus depreciation applies to really any kind of tangible asset.
For the business.
For the business.
Got it.
Yeah.
Okay.
Yep. So typically this is, we're talking to business owners of some sort, computers, cars, furniture, big equipment, all that stuff. Yeah.
And sorry, are we saying there's still time to phase this out further, or unclear?
Nope.
Definitely.
Yeah, and definitely restored. So yeah, we'll see what happens, and anything can happen in the future, but for now, it's here.
Next.
Cool. So yeah, 179 does have some limits. So, it has a $2.5 million limit. So if you are buying a lot of real estate, the 179 election might not actually cover all of it. So the bonus depreciation doesn't have any limits. Okay. So passive and ordinary income. This is where it kind of starts to get fun. Let's talk about the ordinary income and what that is: your wages, your business earnings, interest, portfolio income. And it's taxed at the ordinary tax brackets. There's multiple different kind of tax brackets. There's capital gains, ordinary income, passive income. Each one of them can only offset each other. Passive income, is like your rental real estate. Maybe you're a passive owner in a partnership and you're just putting up capital when you're not actively involved in the partnership. Royalties sometimes, stuff like that. Okay. And so when you have these different types of income, they can only offset each other. Ordinary losses can only offset ordinary income. Passive losses can only offset passive income. So typically what happens if you don't satisfy some of the stuff we're about to talk about, these passive losses get suspended. You can't use them. You get these losses from your investment property and they sit in your tax return and don't do anything until you liquidate that property. So these passive losses often aren't being able to be used. Okay. Cool. So, yeah, I covered this basically. Passive income. When you have, if you have just a rental real estate and you have a 10K loss, and you have maybe 100K W2 income, that 10K loss is going to stay there and not be able to offset any of that W2 income because it's considered passive.
Sorry, guys. Quick question. This may be basically the question. What is a rental loss?
What is a rental loss?
Yeah, loss of rents or loss on like damage to the property or something? Or?
Yeah, good question. The majority of people who invest in real estate, you'll have your rental revenue, then you'll have like insurance, property management fees, and after all your expenses, you're operating at a loss. And typically, even without a bonus depreciation, the regular depreciation typically puts people in a loss state on their rental. So that's what I mean by rental loss. It's basically a net income loss after expenses. Yep.
Thank you.
Expenses. All right. Next. All right, so now we're going to start talking about strategies that allow you to actually use these losses. So we're going to first talk about the short-term rental loophole. Next. Okay, so in order to qualify for the short-term rental loophole, the property the investment property has to have an average stay of 7 days or less. It can have 30 days or less if you provide services on site, aka like a hotel. Like if you have maid service coming and cleaning the guest rooms every day, and some Airbnbs do that. Not many, but but for the majority, 7 days or less, and you must materially participate. Of your questions on that, I'm going to come back on that. And if you're able to satisfy that, we can then classify the rental as an active participation. And that active participation switches it from passive to ordinary. Okay? Which means we can offset ordinary income now. So, yep, if you manage, Airbnb, and you do some of the bookings and the cleanings, and you satisfy the hours requirement for material participation, which we'll talk about in a second, and every guest is staying on average 3 to 5 days. And don't get me wrong, you are allowed to have guests stay longer than 3 to 7 days, but on average. So, yeah, okay. The other way to be able to take real estate losses against your ordinary income is if you are considered a real estate professional status. So the most common industry that satisfies this is real estate agents and brokers. But that's not the only way to do this. Sometimes there's people that are participating in developing activities, and we'll go into some of the other activities. But basically, a real estate professional status is if you do 750 hours in the course of a year in real estate activity. Also, real estate activities have to be 50% or more of your total income producing activities. So if you're a W-2 earner working a full-time tech job somewhere and you're trying to get classified as reps, it's going to be the #1 red flag with the IRS, because what you're signaling to the IRS is that if you claim reps and you have a full-time W-2, you're saying I work 81 hours and 41 of those hours is related to the real estate, and they're probably going to call you bullshit.
Quick question.
Yep.
So for the STR loophole, though, you said you can qualify to materially participate. What would classify as materially participating?
I'm gonna get to a couple slides there, and yeah.
I have one more question though about the W-2. So from the IRS lens, when it's a W-2, they know that's a full-time job? Well, how do they know it's full-time?
They don't. By filing your W-2 and putting it on box 1 there, nothing says it's full-time.
Okay.
So to be clear, it's not an automatic disqualifier, but it is a red flag.
Okay, and if they, let's say, audit you, it's that they're gonna want to see proof of the 50% of your real estate activity, not that the other job wasn't full-time.
They want to see what the full-time was,
Okay.
and what the real estate was. And so like you might work 20 hours on your W-2. It might be a part-time job, like legitimately a part-time job, and you could still absolutely qualify if you are W-2.
Okay.
But usually if you're a full-time W-2.
And I was actually thinking about you specifically when this was coming up, and maybe you're questioning whether your W-2 is classified as active or passive. And like, I guess my question, maybe not, and that's what I was asking. But like, and so is there such a thing as a passive W-2 income?
No.
Nobody knows he's fine with it.
Touche. But no, yeah. By definition, W-2 jobs are typically more active.
But it's not necessarily full-time, right? So,
right.
Okay.
So it's not an automatic disqualifier.
You just have to demonstrate if you're audited that only 50% of your time or less was spent on that W-2.
So if you have a contract that says that you're part-time and you work, 15, 20 hours, or if you have timesheets and substantiation to help you there,
okay,
it's absolutely possible.
Okay.
Yeah. Okay. Okay, so you must materially participate in the rental activity. I'm still going to get to some of the examples of that. And if you qualify, the rental losses are now not passive, but ordinary and are allowed to offset your business income and W-2 income. Okay, next. Yeah, example, you work full-time in real estate, you log 800 hours a year managing your properties, and you materially participate in their operation. You are now considered actively participating and allowed to treat them as active losses. Okay. And the last way that you can use depreciation losses is if it's legitimately used for your business. For instance, next, let's go next. So instead of renting an office for a business, you purchase a building that owns your business. Let's say that Sarah and Suzanne owned this building instead of rent. I actually don't even know what they do with it. Let's say they did own it. Okay. Yeah. And they would actually be able to deduct it in full with full losses beyond, even if it created a big net loss effect, they would be able to use the losses. So business use property for your like office buildings is the most common example. Okay. All right, let's go into the short-term rental loophole a little bit more. Okay, average 37 days or less, material participation. I think I covered this already. Next. And so you have to, for the STR loophole, you got to be actively involved. So you got to be able to log 500 hours of managing the property. And you have to have more involvement than anyone else. So, you know, this does get a little tricky when you outsource 100% of your activities to a property management company. Now, it's not, you can still do it. You've got to kind of be strategic that you log more hours in that property management company. And then we're going to go into some examples now of the of what is what counts and what does not count. So what does count? You can be involved in acquisition, like, you know, the actual scouting out and purchasing properties, developing, building out property, maybe purchase it and then you spend time actually painting it, installing stuff, putting in furniture, the actual rental operations, you know, the day-to-day management, property management, if you do it, your own property management, if you do your repairs, cleaning, and guest communications. Also, if you coordinate with these kind of people, if you're like having meetings with your property managers, your cleaners, all the calls, all that stuff counts. Okay. Next. So basically, you must be actively involved, not just putting money into it, getting a property management and sitting back and watching it go to work. Next. There is a 14-day limit. I was just telling Sarah about my dream to purchase 26 STRs in 26 different ski towns across the United States and going to live out of them for 14 days out of time. Now, one of the things about that do qualify as material participation is site visits and inspections, like you as an owner going to put eyes on it. Now, what does not count is the travel time, like getting from California to Florida to go look at your, you know, your Florida property. The flight doesn't count. But once you're there on site and like inspecting it with your own two eyes, site inspections count. That's one of the things I tell their owners to do. Like, go use this property that you invested in and, you know, inspect it. It's a great way to get close to that 500 hours. Okay. Next. The IRS considers real estate professionals as active, like, you know, running their own business, and they truly are. And so when you're a real estate agent and you're also investing in your own properties, they're basically saying that these people are allowed to, or they're considered a real estate professional, and they're allowed to treat all their real estate activities as active, even their passive activities. Okay. And so for reps, you can offset your W-2 income and your business profits. How many of you guys are agents or brokers? Cool. So you guys are shoo-ins, essentially. Cool. Next. Number one criteria, 750 hours in the year. Next. You must be, like I said, more than 50% of your time related to the real estate activities. You still have a W-2 job, but what you do in real estate has to be more than your. And the best way to do this is logs. I have templates. If you guys ever want a template, some G Sheet templates that you guys could use as logs, track your hours, as drop downs for the different activities that are included. The best thing to do is just be able to create some kind of log. The thing about logs and your time is they're hard to audit. Let's just say like that, like get it on paper somewhere. And if you are audited, it's really hard to go back in time. I'm not suggesting anything. I'm just saying that, you know, get it on paper, and that's what matters the most. Get it on a G Sheet or an Excel file.
I had a question on that. So when you're logging hours, like for example, Jenna and I were painting baseboards or standing baseboards this weekend. Both of us were doing that.
Yep.
Can we count those overlapping hours?
Yeah. Yeah. And so that's a great question. Spouses. Yeah.
Got two of them.
That's also a great question. I wasn't prepared to answer, and I'm inclined to say yes because the spousal rule allows that even if you're technically being classified as like, you know, the STR owner, it goes into the family tax return. I think if those kids are probably under 18, that counts too. I'll get back to you on that.
That's 24 hours towards the 101 day.
Exactly. I'll get back to you on the kids. That's a great question. Put your kids to work and double, quadruple your time in one weekend.
Would activity mean like even real estate meetings, networks like this?
That's a great question. For reps, it does. Yeah. Events and conferences. Here we go. Coordinating repairs, just like, you know, working with your team. You don't have to be the person doing it all the time. Sometimes just coordinating with people, maybe the events, conferences, and continued education. Absolutely. Advertising, marketing, the customer support, if you're coordinating with guests, all that stuff. If you're, you know, taking time to plan the repairs, all that stuff counts. Yep. Next.
Hey, Casey, what about your hours spent researching the property and going to inspections before you purchase the property? Can you count those hours?
Now, that's a great question, and it's a little bit twofold. For reps, yes. For STRs, no. When you're purchasing an STR, what counts is the time after the property is owned by you. So the actual acquisition time spent scoping and looking at sites, unfortunately for the STRs 500 hours, no. For a real estate professional, yes, it does.
Got it.
Yeah.
Dun, dun, dun.
So I'm licensed GC and we do flips and development and stuff. Is that considered real estate?
It is. However, when it comes to the real estate professional status, the actual flipping activities, there's a couple activities that, you know, for the lenders and the flippers, lending does not count. The development activities for flipping does not count. Has to be long-term holds. Yeah. Yep. So, yeah. So that's really good to know. The hard money lending activities, you know, flipping development activities. Yeah. So Sarah owns 4 rentals, manages all operations herself, and she logs 800 hours. She's going to be a spouse. She's able, and this is where I advise a lot of couples that are married, when one person's a W-2 earner and the other one is maybe an entrepreneur or an investor, you guys could complement each other really well. Use one person, you know, themselves together and stuff. It's W-2 income. Okay. Okay, to qualify for reps or STR deductions, you must be actively involved. The following activities do not count. So let's go into this a little bit. All right. So take a quick look here, basically the financial and investment properties, lending, if you're just doing passive investments in like syndications and REITs, the construction and flipping does not count unless the construction is tied to rental properties that you own, but not just the flipping. The actual back office kind of stuff of doing this, the admin, the accounting, bookkeeping does not count. If you're just doing investor stuff, looking at budgets and figuring out the money portion, that does not count. And there is also one more, next. Travel and education. So to be clear, for real estate professional status, the attending seminars does count. For the STRs, it does not. Travel time does never count. Capillaries and activities does not count. Okay. All right, next. So once again, if you are owning property for your business, next. It is fully eligible for full depreciation. And so once again, if you're able to classify that property in with a business activity, it then automatically becomes non-passive and active and able to be used with your business income. Next. Okay, next. So your material participation is regular, continuous, substantial involvement in the property. It's connected to another active business. This is related to business use property. Okay, I think the biggest example is like if you purchase a multi-story and you rent out, one floor for your business, and then all the other floors you rent out, to other businesses, you could still deduct the whole building cost against your active business. That's an example I just gave. And yeah, essentially the rental income expense is related to all the other, part of that building is used to offset. So like in the example of using Compass CPA, all my accounting income can be offset by the rental incomes that we generate from that building that we own. So this is where on more the macro level, going back to Donald Trump and all the billionaires out there that are not paying taxes, they are doing this essentially. They always have their own real estate leg of their active businesses. And this is why the corporations out there, Amazon, Google, all of them are not paying taxes. They have their real estate. And their real estate allows them to basically get their business. And the best part about it is they don't put down money on that real estate. They lease it, or not lease it, they get lending on it. They leverage that real estate. So they put sometimes 10, 15% down on $1 million properties, but they get a full $1 million deduction. It doesn't matter how much cash you put up or how much lending you do on that purchase. What matters is the purchase price. It doesn't matter how you got it. So people are creating tax deductions on loans. And that's what's happening at the macro level.
Do they have a separate company that holds the real estate? Okay.
Yeah, typically. And then they are able to kind of group the activities together. But they'll typically have LLCs separated that have the real estate holdings and then the active ordinary business, which is also what I for all my if you're building a portfolio, that's what I suggest is the spoken wheel, where you have one LLC that holds all your other real estates, and they on different spokes, and they roll up to that wheel. And then on the back wheel, let's say it's a bike, the front wheel is all the holdings and the back wheel is the operations business. Okay. All right, next. Okay, Airbnb property running 200 days per year. He's less than 14 days. That's going to be eligible. It's going to be qualified as an STR. Next.
A quick question. Sorry, you said if you're at the property, quote unquote, inspecting it,
Yes.
that is not counted as personal use of the property, or it is?
I would strategically not classify that as personal use. I think there's some ways around that personal use, right? Like I would probably, and it's commonly done, is go down and say like today is about inspecting, maybe tomorrow's about inspecting too, and then maybe say there are a couple extra days, and you could stretch out that 14 days a little bit. Yep. Cool. And with the STR there, you're able to classify it into bonus depreciation. Owner occupied real estate, same thing. Go ahead, keep going. Same thing as what I was saying before with business owned property. It's pretty much the same example. This is very common, like, sometimes the owner occupied lending is more preferred for lenders, or, always looking to more better loans sometimes are available when you're purchasing an owner occupied commercial building, and you're taking out maybe the first floor and running out the rest. Okay. Cool. Keep going. I think we covered a lot of this, and we're starting to get. I think we have a couple of duplicates I didn't catch. Keep going. All right. Now let's talk about some real life examples. Oh, okay. That's what we're in right now. Okay. Sorry, I forgot what section we were at. So we're in some real life examples. All right. So this one is called the American Dream. I'm actually changing my mind. There's another one in here. I think it's more of the American Dream. But let's just use an example that you're here in Bend and you're purchasing your primary home. Maybe you're out in Deschutes River Woods. You have all this property and you build an ADU on there. You can essentially allocate a purchase price or the build out price over to that ADU. And you make that ADU a short-term rental. And so this is how it will work for your primary home. No, you can't do a cost segregation on your primary home, but on your property, you might have a short-term rental. And maybe you want to move somewhere, and maybe duplexes or another colony in this case. And you buy your primary residence. You build an ADU or separate maybe the basement floor or something, do a duplex, and then you do a cost segregation on that part that you convert to a short-term rental, and you're able to then create a big depreciation event that you get a loss coming through to offset your W-2 income. And now you are able to do a tax return where you get a big refund, and that down payment you put down on your home comes back to you. So actually it's another way. I know there's 0% loans out there, but it's another way to like kind of have a rebate on your home purchase. Okay.
Is that what people also call a house hack?
I would say so.
Same idea, right?
Yeah. This is what I think is the real American dream out there. If you want to live a year-over-year tax-free lifestyle, I think the BRRRR plus cost seg method is the way to go. Essentially, buy a property, maybe it's a little bit of a fixer-upper, you rehab it, and then you do a cost seg on it, and you're going to get a big depreciation from that cost seg. But then you got the equity in that property, and you're able to pull that equity out through like a HELOC or a HELoan, and you have not just the HELOC equity, but then you have the big refund coming from the cost seg, and between the two of them, they catapult and almost like double your potential in the next year's investment. And next year you do the same thing, and it just keeps expanding your buying potential. Mm-hmm. I think that method is one of the best methods for if you're going to build a portfolio. Consider that method, because you could essentially double down and triple down much easier.
Question on that: Would it be beneficial to do a cost seg on the house you've already moved out of and refinanced?
Yeah, frankly, if that's one of the things I actually didn't cover, but you can do cost segs on houses that you purchased and put in place in previous years.
Okay.
Or so what if you didn't do it in the year of purchase, it's not lost.
Okay. Sure.
Yep. Okay. Cool. Next. Yeah, this is just a little visual example of, how you can get a lot more money. The bonus depreciation creates a tax saving of 65K, and then you've already put a bunch of equity into such a property. You go from, not really having any cash because you just put money into investment to now having over $200,000 to invest in your next property. And HE loans and HELOCs are often, favorable terms, similar to mortgages. So it's a good way to use and leverage debt. Okay. This is just going into a little more of the details, but make it a repeatable method. Every single year, use the equity in your home and the tax refund to repeat this method. Yep. And that's how you can scale a portfolio quickly. So if you want to go from 0 to 60 with your real estate investing, consider that BRRRR plus cost seg method. All right. Compass CPA, we do fully engineered studies. I have a couple engineers on my team, and we will do virtual walkthroughs of property. Sometimes I do in-person walkthrough. Sometimes it's a perk of being, in this job. Maybe, Suzanne offers to put me up at her place in Hood River for a night or two, and I can go, go have a date night with the wife and do my physical walkthrough myself. But it's unnecessary. We have property managers do that. A lot of the times when you're buying an Airbnb, your first thing you're doing is taking all the pictures and stuff for inspection anyways, and you can reuse those pictures. Basically, whether it's property managers, yourself, us, we have teams, we have an outsourced photo team that operates almost in every city and state, so we can do cost segs all over the United States. Walkthroughs, and they're fully engineered studies. So we're not just doing statistical studies that are much more conservative in their results because they are statistical. So they don't want to, be too aggressive because they're not actually looking at anything. They're just plugging in the size of the property, the type of property it is, and it creates an algorithm, spit out a calculation of something that's going to produce 20 to 25% results versus a fully engineered study that you're going to get somewhere between 25 and 40% in ROI on that. Is much higher than the cost that you're spending. So don't be short-minded when it comes to investing in the cost seg. If you don't go with Compass CPA, ask your provider, is this a statistical study or a fully engineered study? Cool. And I think that's about it. I can't believe you guys
Yeah.
did that.
We'll open it up to Q&A. And Casey, I just want to say, that was record time for the amount of slides we had. So, that's why we kind of hustled through, you guys. There's so much content here and we didn't want to miss any of it. So yeah, open it up to questions and then we'll talk about next steps and how you all can connect with Casey after today.
That's kind of what my question is about. Do you do initial consultations just to talk about situations
Absolutely.
and stuff?
If you ever want to talk about cost seg, I'll do 30 initial consultations. But even just like regular tax services, my firm does bookkeeping and business services. So if you ever need a bookkeeper or a CFO, we do monthly business services like that. We do tax planning. So outside of the cost segs, we have a ton of other strategies. I saved just recently, one of my clients sold their business for $100 million, $27 million tax payment on it. We squared it away for $10 million, saved $17 million on that transaction. We do large scale tax mitigation strategies all over. So property, a business, crypto, talk to me. We'll do free consultations. We also have, if you're a business owner, more kind of like low hanging fruit, everyday strategies, Augusta rule, accountable plan, putting your children to work for the business. We're much more actively involved in tax planning than the traditional CPA firm that just you give them your stuff and they file whatever you give them. We are much more involved in strategic planning and always offer a free consultation.
Do you do the actual like tax filing too?
Yeah, yeah. I have a team of about 5 CPAs that I work with. My tax director, he's in Missouri. We're all agnostic to the state. I'm a California and Oregon CPA, but I do taxes in New York, Hawaii, like everywhere in between. Yep, we can do taxes for your business, for your trust, nonprofit, anything.
Cool.
Yeah. Yeah.
Do you help create trust?
I don't create trusts, but do have some attorneys that can put them up. My business partner, he's a financial advisor. He does some basic trust creation. Well, more, yeah. No, he does not. He does basic estate planning. Sorry. So the trust creation we refer out.
500 versus 100 hours for STR.
Yep. So the 500 hours is essentially you got to work 100 hours more than anybody else, right? That's if you're like property manager. If you have a property manager, you want to make sure you're doing more coordinating and managing like the website. You want to make sure you have some kind of role that you're able to satisfy the more hours than anybody else, or just have 500 hours of just any of the activities. Yeah.
400 hours is big.
Right. Yeah.
So Casey, you live here, right? Okay.
I do. I live over on the west side. I have an office in Northwest Crossing.
Mhm.
So if you ever want to come see me and have in-person planning, Northwest Crossing, and Tuesdays and Thursdays I work from home. I'll come have coffee with you at like that Porch Coffee or anywhere in town if you got somewhere you like. But yeah, I'm here in Bend.
And I'm just curious, it's kind of a personal question, but do you invest in real estate here?
That's funny. Sarah was just asking me that. And my wife works for Airbnb. Yeah, it sounds like what's going on. Ask me again next year. I will have. I will have. Like I said, she's always just wanting to save her money. Anytime I talk about buying anything,
I have a good strategy for you.
I'm all ears. Yeah, let's talk.
Low entry fee.
Okay, yeah, I like it. And that's what I'm saying. I think there's a common myth around like real estate. I've worked with a lot of lenders and I've learned all the different kind of lending between like 1099, situations and business owners and people who are teachers and stuff. There's so many different ways to get into real estate where it doesn't have to be a huge commitment down. Then you introduce stuff like this and you can get money back to you if you did put money down. So that's what I'm pushing her towards. And she was going to come here today. She should have. Yeah.
Just one more question. Does it get really complicated if you have partners and you're doing these kinds of things?
It's a great question. I mean, more cooks in the kitchen, more decision makers. Yes, it absolutely does. I'm this week doing a cost egg right now for a partnership, and they 4 owners have 5 properties in Cleveland. Luckily the 3 of the other owners, one of the owners really wanted it. And they're like, hey, they only get 25% of the losses, but it helps them out a lot. And the other 3 owners said because it doesn't go to waste if they can't use it, because it's trapped in the passive losses. And so whenever you do have passive income, they get to use it, but they might not benefit from it. And sometimes they don't want to incur the cost. And so it's just more people you got to coordinate with, and not every partner in a partnership always qualifies, because it's possible for one partner to qualify for the short-term rental loophole and the other's not, because they might be passive partners.
You mentioned something about being able to do the cost seg in years 2 or later. Is there more benefit of doing it in the first year, or is it still
similar? Actually, it kind of depends, on the income year you're having. You know, if you're having a normal year maybe, and then when you buy the property, then the following year you have a ton of income and you're trying to find every strategy possible, might make sense not to do it in that first year and then strategically do it in the second year and essentially catch up for that first year, but take the deduction in that second year. So it's kind of about matching it with, you know, the income years.
Makes sense. And remind us how far back you can go to redo taxes in the past. Like, it's not indefinite, obviously.
3 years is the amount. It's 3 years. But you can actually do cost tags for properties put in place beyond 3 years. So the amending, typically the cost tags, when you do a cost tag, the IRS wants you to do an adjustment in the current year using Form 3115 and a 481A adjustment. And they want you to do it in the current year, and they don't want you to do an amended return. But there's ways to essentially clean errors, because when you are allowed to do an amended return, it's if there's an error on the return. And one of the ways that we get past that, and sometimes we'll go back and actually amend a previous year. And why would you do that? Because you've already paid the taxes and you can get the taxes back immediately when you amend versus waiting until you file the next year. But sometimes when you don't class assets in, when you don't class the assets in the 5, 7, and 15-year classes, you can say that was an error in asset classification. So that's how we've managed to do amended returns. Fun.
And that's something you would take care of.
Yeah. We offer full audit support. So if you're ever audited, we have an audit file. Our cost tags are fully engineered, so it's the most substantiated kind of return you can do, like versus like a statistical study. That they're actually more substantiated with photo evidence, blueprints sometimes, and the RSV's database, and a lot more working papers that we do. So we'll stand by any cost tag.
Yeah, that's the link to sign up for him for a 15-minute, or is it 30-minute 30-minute consultation if you want to.
Everyone has QR codes instead of business cards nowadays. Yeah, you guys notice?
I do have this.
You have business cards?
No,
I don't have
I
business
didn't
cards
bring
anymore.
one. I do have them. I might have them.
And we'll circulate more of this stuff too.
Well, thank you guys, everyone, for coming. And Suzanne, Sarah, thanks for having me.
Thank you.
And I look forward to hearing from you guys, or I hope you found this helpful at the least.
Yeah.
Thanks for sharing.
Yeah.
Guys, we always have a Meetup replay as well. So this is recorded and this will be on our YouTube channel by next week. So you guys can go back and watch it as a resource.
Thanks, Casey.
Thank you.
Guys.
See you, man.
Yeah, good to see you too. Cool.
Thank you so much.
Thank you.
Thank you.
Thank you.
Get back safely.
Au revoir. You get to stop by the office and bug Suzanne. Sorry.
Come visit me.